Now, the US markets reversed their losses overnight, but the sectional performances were very, very different. And although the indices finished close to square, down slightly in most cases, the sectoral performances within that were very remarkable. And it's no surprise that we saw huge pressure, particularly on travel-related stocks. Airlines, cruise lines, all down hard. Norwegian Cruise Lines down 10.5%. In contrast, we saw huge support for defence stocks, so Northam Grumman up 6%, and for energy stocks. And that energy rally was repeated around the globe over the last 24 hours. It started here in the Asia-Pacific region, and we saw very good support for the likes of Woodside and Santos, up 6 to 8% through most of the trading day, with some of the smaller plays like Karoon Gas up 15%. And given that we are hearing now that the conflict in the Middle East will run for 3 or 4 weeks and the blockade of the Strait of Hormuz has begun, crude oil prices could be heading higher, and with it, other energy stocks. It's not just oil and gas stocks, by the way. Uranium stocks are also running. All energy and alternative energy stocks are also running. All energy stocks are in focus with investors at the moment. There's no surprise. Crude oil was up 6.5%. Natural gas was up more than 10% in trading yesterday. Bitcoin caught the rally, as we suggested, up 6% in overnight trading. Perhaps more concerning was the lift in the volatility index. The fear and greed index rose again up to 21.5, and above that 20% level we often see as the divide between fear and greed. It's pretty clear markets are moving into fear mode. But of course, life in the markets goes on, and we'll still see the company reports that are scheduled. In the US tonight, we've got Target and Best Buy, and we'll also see some manufacturing data out of the US tonight, but given the macro conditions, that one might get swept away. Now, just as we saw in the Asia-Pacific region yesterday, US investors initially sold off. It was a classic risk-off kind of move, and the share market was hit no matter which indice we look at. However, over the course of the session, just as we saw in the Asia-Pacific, there was a bounce back and a more nuanced response. But overall, share market investors appear to be reasonably optimistic about the outlook. That is, that we're looking at a short conflict in the Middle East of possibly 3 to 4 weeks that will achieve Israel and the US's goal in the Middle East, and that is to bring about regime change in Iran and defang the forces that have been attacking Israel. So that's a pretty optimistic interpretation, and the evidence from other asset classes is that might be too optimistic, and that big bounce back we saw in shares around the globe is not matched by the action we're seeing in other markets. Now, gold and gold stocks naturally are finding support in this environment. It's pretty clear there's a desire for safe havens. The US dollar is rising and is in fact approaching 38-year highs against the yen, another sign of risk aversion from global investors. However, the reaction in bond markets is pointing to a secondary effect that share markets might not have priced yet, and that is the potential for inflation. Now, naturally, the first blush reaction to the outbreak or the escalation of conflict in the Middle East was to buy bonds. They're a classic safe haven investment. However, in the secondary reaction, we saw a sell-off, and US 10-year bonds actually moved up 10 basis points, a big move in bond markets, on the idea that the blockade of the Straits of Hormuz might mean that the energy markets globally will be disrupted, and potentially for longer than the 3 to 4 weeks that the share market seems to be expecting. If that's the case, inflationary effects are likely to be felt around the world. Energy lies at the heart of every economy, and whether we're looking at alternative and renewable sources, we're looking at fossil fuels like coal, oil, and gas, or we're looking at other sources such as uranium, all of those sources of energy are likely to be bid in the current environment as the world's energy supply is imperiled by the blocking of the straits that the Persian Gulf delivers its oil and gas from. So that's the big concern for markets. Share markets don't seem to be reflecting that at the moment. While we've seen plenty of pressure on high-flying, glamorous tech stocks that might be overvalued, and we've seen plenty of pressure on credit markets as concerns about private credit have arisen, we're not seeing a general de-rating or an increase in the risk premium to hold shares, despite what is a clear escalation of geopolitical risk. So the markets are priced in the share markets are priced in a very short impact. Um, uh, but if the conflict does expand, share markets are likely going to have to reprice that thinking and rethink how long this might work out. Because at the moment, I would suggest in share markets, there is no reflection for the potential for a drawn out conflict with oil prices consistently higher for a longer period of time, forcing inflation higher. And of course, with higher inflation, there's no relief from central banks, and stimulus programs from governments would also be very dangerous in a higher inflationary environment. In other words, there's nobody to ride to the rescue if the global economy starts to slow while there's an outbreak of inflation. And that scenario, in my view, has certainly not yet been priced into share markets. So perhaps investors should be thinking hard about whether or not the recent sell down does, in fact, represent a buying opportunity. So turning to our watch list today, we're looking at CrowdStrike. Now, CrowdStrike has been extremely volatile, at least its share price has been, and there are good reasons for that. It's very popular software. It had some well-known problems last year. Nonetheless, the increase in cyber threats has certainly seen support come into the stock. At the same time, concerns about the impact of AI on their business saw selling as well. So the moves in CrowdStrike have been quite substantial. Last night, CrowdStrike was up 3.5%. It is reporting tomorrow morning. Now, it's expected that CrowdStrike will report revenue increases of 23% year on year, and for the first time ever, report a profit, a fairly modest profit at about 4 cents per share, but nonetheless a profit. A number of analysts have gone to a buy rating on the back of this expectation. The stock is down 19% year to date, so it's coming into this result positioned quite defensively, at least in terms of the share price. And a number of analysts are starting to push into the stock, with Wells Fargo overnight declaring it is overweight in CrowdStrike shares. Berkshire Hathaway also reported. Now, Berkshire Hathaway, one of the most famous investment groups in the world, of course, formerly headed by Warren Buffett. This is its first report under the new CEO. And unfortunately, fourth quarter earnings were down 5%. Fourth quarter earnings fell 30% to $10.2 billion. The stock fell 5% in overnight trading. The big hit here was in insurance underwriting. Income was down 50%. They purchased no stock. Berkshire Hathaway purchased no stock in the quarter, and their cash levels are now at $370 billion. And if that doesn't give us clues as to what one of the most famous investment houses in the world is thinking about the market at the moment, we're not paying attention. Its shares are down 7% over 12 months. The average target price significantly above the current levels of $480 a share. A lot of those targets between $535 and $585 a share. So plenty of people seeing upside. Of course, the key to it will be how does Berkshire Hathaway deploy all that cash that it's currently sitting on, and when does it deploy it? And the third stock on our watch list today is Capstone Copper. It has its fourth quarter results out. EBITDA up 79%. No surprise given the strength in the copper price, but certainly good news for Capstone Copper shareholders. $434 million profit. They've also dealt with their industrial relations problems, very importantly, and they've brought an end to the strike action. Their guidance for 2026 is 230,000 tonnes of copper ore. The stock is down 4.5% year to date, but it was up 63% last year. So perhaps that's just a moderation of the interest in this stock. But a number of analysts with a strong buy on Capstone Copper and a target price up around 1660, as opposed to the current price for Capstone Copper closer to 1450.